When a football club spirals into financial ruin, the immediate demand from fans and external stakeholders is to bring in a Big Four auditor. The assumption is that these global firms will crack open the club's financial black box, deploying a forensic investigation to expose fraud, predatory player sales, and shady agent commissions. But a standard external audit is strictly a compliance exercise. It is designed to ensure the numbers presented are materially accurate, not to evaluate the club's business performance or operational integrity. This is why a club can possess fully audited financial statements while quietly bleeding out. An auditor is not tasked with pointing out disastrous management strategies. Bridging this gap requires deconstructing the mechanics of the audit itself. It is a process that leads to the maturity inversion, a paradox where the most professionally run clubs need elite auditors the least, while deeply troubled clubs are forced to use them as an expensive institutional passport. Misunderstanding this mechanical limitation leads restructuring clubs into a financial trap, wasting millions of dollars applying a routine compliance tool to a severe strategic crisis. The typical external audit spans the calendar year and rests on a three-step operational foundation: planning, internal controls testing, and substantive testing. This diagram shows the materiality threshold in action. Materiality is a strict numerical tolerance limit for errors, calculated by the auditor based on the specific size and revenue of the club. Massive financial discrepancies, like a missing zero on a broadcast contract, are caught in the filter. When this happens, the club must adjust their statements or face a qualified opinion from the auditor. But smaller, questionable transactions or cumulative accounting errors fall below that materiality limit. They slip entirely through the mesh. Therefore, a clean, unqualified audit opinion guarantees only that errors above this specific threshold have been corrected. It is a mathematical tolerance, not a promise of absolute ledger accuracy. Once materiality is set, the auditor moves to substantive testing, applying mechanical checks directly to the club's revenue and expense accounts. This process relies heavily on random sampling to verify the simple existence of a transaction. The auditor checks whether a specific invoice for an expense matches the corresponding bank statement. They verify whether an economic rights split or an agent's commission was properly recorded on paper. They do not calculate whether selling that player was a strategic blunder or if the commission itself represented fair market value. This mechanical limitation becomes obvious when auditors test contingencies, specifically the volume of labor and civil lawsuits common in litigious environments like Brazil. Because troubled clubs often face dozens of new legal claims every week, full analytical coverage is impossible. The auditor must establish arbitrary cutoff dates and rely heavily on loss probability letters drafted by the club's own lawyers. A pristine audit signature confirms that the club mathematically accounted for its decisions according to the rules. It offers zero commentary on whether those decisions are leading the club toward bankruptcy. Moving a club out of the financial dark ages requires adhering to the pre-audit mandate. The internal house must be ordered before an elite auditor is ever engaged. This chart illustrates the financial penalty of ignoring that mandate. In recently restructured clubs, accounts payable, cash flow controls, and basic bookkeeping are often in disarray.
As disarray persists, the cost of bringing in a Big Four firm skyrockets. The shaded area under this soaring cost curve is the disorganization tax. You are paying premium hourly rates for elite consultants to execute basic data reconciliation. They are performing the clerical cleanup that should have been managed internally. The rule of engagement is absolute. A Big Four firm exists to verify operational excellence, never to organize internal chaos. And before you sign that engagement letter, you must apply a rigorous conflict filter to the candidates. Any firm that operated inside the club as consultants during the years of financial ruin must be disqualified. True transformation requires a forensic look-back from a completely independent firm that was not in the room during the crisis. If management skips this internal stabilization phase, they are not purchasing a seal of transparency. They are merely subsidizing a global accounting firm to do their baseline bookkeeping at an exorbitant premium. The relationship between a club's professionalism and its choice of auditor is governed by the maturity inversion. Look at this matrix mapping internal controls against auditor requirements.
The irony of compliance is that clubs with airtight internal systems can secure the same technical rigor from a specialized mid-tier firm, entirely bypassing the Big Four prestige premium. Top-tier European clubs frequently populate this quadrant. They safely forgo the Big Four because they already operate under the strict overarching regulatory scrutiny of UEFA's financial fair play. Conversely, chaotic management in emerging markets often use that European example as a shield. They place themselves in the low control quadrant, hiring smaller auditors specifically because those firms are easier to influence. Despite this dynamic, there are narrow, high-stakes scenarios where paying the Big Four premium is an absolute necessity. When a troubled club engages in formal corporate restructuring, launches an IPO, or undergoes a merger, the Big Four audit acts as an institutional passport. In these moments, the audit serves as a marketing campaign. It signals to wary external financial markets that the era of the dark box is over. The Big Four signature does not transform a chaotic club. It simply ensures the global market believes the club when executives claim the transformation has occurred. Ultimately, an external audit functions as a mirror, accurately reflecting the true operational reality of the club. If the internal accounting structure is chaotic, the mirror will simply reflect that chaos, usually in the form of a qualified audit opinion. But if the club is operationally sound, it does not require the most expensive mirror on the market to prove its worth. It only needs an auditor that will not distort the truth. The objective for restructuring clubs is to move past the once-a-year scramble to secure a compliance certificate. The superior target is fostering a continuous open-book culture. By operating with radical transparency, management effectively turns every fan, investor, and stakeholder into a vigilant observer. This generates a 365-day system of crowdsourced oversight. The public clamor for a giant accounting firm to save the day is almost always a symptom of an opaque, old-school management regime desperately trying to hide its real members. When a football club finally commits to operating in a glass house, the elite external audit ceases to be a weapon to uncover the truth. It becomes a routine validation of standard operational excellence.